Hi everybody, I'm Shukri.
I'm Amir.
And together we are the
Property Tax Specialists. Thank you for taking the time today. And this session will be recorded, so it will be sent out afterwards to everyone who's registered. We'd like to start with today's focus about ownership structures and avoiding the pitfalls. In today's program, we'll cover the basic tax planning and structures, why structure in the first place, what structures are there and the advantages and disadvantages of each, when best to utilize different kinds of structures. Then a question we get commonly asked in these webinars is the costs and tax implications of changing structure. So when someone sets up something and want to change it, we'll cover that on that as well. And one of the other things we will be covering is the considerations for structuring, and the key is before purchase. The objective of today is creating awareness. It's to help you ask the right questions, but more importantly, make more informed decisions.
But before we do any of that stuff, we've got to do the formalities, of course. A little bit of a disclaimer as per usual. Whatever we talk about here, it's of a general nature and for information only. It is not designed to be advice. Advice is specific to your particular circumstances. So we recommend that you consider advice with a professional advice specific to your particular circumstances.
I am a limited authorized representative of Merit Wealth. What that implies is I can provide advice on super funds, establishment, formation, and wind up. I can also advise on contributions, and if you're looking to buy a property in a super fund, I can advise on that as well.
But before we start, let's have a look at some of the questions we keep getting asked within the practice to give you an idea where we're going with some of this information. The first example is, say, a property in John's name. When he bought it, he structured it in a way where he had negative gearing, which means a rental loss. He was offsetting the rental loss against his other income and saving on a little bit of tax. After a few years, it's become positive, and John comes to us and asks, well, can I transfer the property or allocate some of the income to his partner who is on a lower marginal tax rate? That's one of the questions.
Another common one is if the property is in a trust, Tom pays land tax and the property is negatively geared. So can Tom transfer the property from the trust name to his individual name to maybe benefit from the negative gearing, reducing his tax and the land tax thresholds?
Then we've got Jason, who is on $180,000 of income, and he has a positively geared commercial property investment. He keeps asking, can I transfer it to the self-managed super fund? That's a major question.
And the questions mostly focus around, I've got this property, can I transfer it from a trust to an individual, from an individual to a trust, from a company to a trust, from to. And that's what we're going to be covering today. Instead of making a decision at the end, trying to figure out what's the best position to start off with.
And a very common question we have, because, say, particularly for Sydney people where land is scarce and expensive, we got people who go buying land with a view to constructing dwellings on it and a bit of subdivision. So you get an option where you say, well, okay, can I keep one and sell one? What are the positions there and what are the outcomes? How about we sell both? All right, and then other options include keep both for rental, or maybe occupy one and access some main residence exemption and sell the other one. And what about opportunities for development? That's a very common question at the moment we get from entrepreneurs out there. So the key is going to be, the starting point should be what the management guru Stephen Covey always refers to. How about we start with the end in mind? So the question to you is, what do you want? Do you want to protect your assets, minimize your tax, retain maximum profit from the project, or transfer the assets into legacy to your children without incurring tax? So the key is going to be, what do you want? You have to think about moving forward.
And some of these things could be, you could have one benefit and the other, which will cost you the other. It's finding the right balance of everything that suits you. So the people we help structure investments to minimize tax legally, of course, maximize their return, protect their assets while keeping the ATO happy. And that's key.
And here's an example that Amir will give you.
So, for example, if someone's on a $250,000 income, they'll be paying about $88,000 in tax each year, or 35% of that on an average rate. If there a legal way to split that income between two people maybe, and then each one will be paying about $34,000, saving the group $20,000 a year. That is a good amount of money that I'm sure you could think of many ways to utilize.
So let's talk about what sort of taxes are actually on property. Firstly, we've got income tax. An income tax includes capital gains. We do refer to it as capital gains tax, but capital gain is actually income which has to be included on your tax return. It's just the way it's calculated a little bit differently. Then we've got state taxes, which include stamp duty on the purchase, or land tax. And of course, the threshold for land taxes are important when you're holding the land in a trust. For example, in New South Wales, you'd get no threshold, but in Queensland, you get $350,000. So that may have a bearing on your decisions. The other thing is rates. Council, water, and other levies, they're taxes on the land. And finally, GST, particularly relevant to commercial property. You have to work out whether you're going to pay it, not pay it, and then once you're generating commercial property, you would want to, rental from commercial property, you would have to charge it.
So the question is when to start? And the simple answer is it's always best before you sign on the dotted line. And this is for every single purchase because circumstances change, rules change. It's always best to assess each property before you buy it.
And part of that, of course, has to sit within what your situation is, your personal life circumstances. From one purchase to another purchase, life changes. People grow up, people pass on, relationships change. Also, you've got to look at your personal tax circumstances. So you may be in receipt of some other income. You may be part of a new business. You may have incurred some losses. So that's the sort of stuff you've got to consider. And finally, you've got to look at the structure that's appropriate for your circumstance. Once you discuss and decide, test it. See if it's appropriate for you, for that particular property. And finally, you've got finance. Is the structure going to help you with the lender? Are they going to give you the money?
And a key point in this one is point number 2. We always get people who want to pay minimal tax and they want to structure their lives around paying the minimal tax. It doesn't work that way. You structure your life and then the tax comes secondary to fit in with what you want to achieve.
So people come and ask and says, well, you're the accountant, what do you think? So my approach and Amir's approach, broadly speaking, is how can we split income to minimizing tax? How can we structure the assets so that the income is generated and processed in the member of the group who has the lowest marginal tax rates? And when you add them up, then what you've got is a minimum tax for the group.
And that takes me back to the example of the $250 in one person's name. And if it's split, you'll be saving $20,000 a year.
And then you've got timing. Timing can give you and improve your yield. Okay? We are now in June, 3 weeks away from July, and that's relevant for capital gains particularly. So capital gains is calculated on the basis of the date on the contract. So if you sign the contract before the 30th of June, you're going to have to report the capital gain on the 2023 tax return. But if you happen to delay the signing until July, then you've got about 18 months before you lodge your next tax return, and the tax money can be used. Some of our clients will use that tax money to complete some development projects or finalize some other projects or start another one. And by the time it's due for payment, they've already got the cash from the last project which they just finalized. And then what you've got is you've got some structuring, okay? Now, Amir, why don't you tell us what structures are available?
So, why do we structure? The key reasons are to protect your assets. You've worked hard for your assets. How do you protect them from third-party creditors or other people? How do you minimize your tax legally? How do you hide your wealth from the public eye?
Because some people have sensitive positions and they don't really want everybody to know. about what they have.
Another consideration is planning for retirement. What do you want your retirement to look like? What are you going to do now to plan for it? And another consideration is family succession. How do you give the wealth that you've created and you've protected throughout your life to the next generation? How do you do that without triggering capital gains tax and stamp duty?
So some of the considerations to help decide. Firstly, we want to talk about asset protection. What's your risk profile? For example, I had a doctor come in to see me one time and I said, what do you do? He says, I'm a doctor. What kind? He says, a radiologist. I said, where do you work? He says, Princeton. I thought that was somewhere up the central coast of New South Wales. It turned out to be Princeton University Hospital in the United States. I said, what's the problem? He said, they'll sue anything that walks over there. How about we get some protection here? Then we've got examples like the people we've had who are on the hospitality industry. They've had quite a bit of suffering and they've lost their businesses as a result of the pandemic closures. Now, what you don't want is you don't want to lose your house as a result of economic conditions changing and so forth. So that's one of the major asset protection positions you want to take. After that, some of the considerations will be, how do we income tax minimize? Yep, click it on. Okay. Anyway, so the question is going to be, how do we minimize the income tax? And we've considered that in the last couple of slides. We look at what way can we put the structures so that the income comes in and is paid by the person with the lowest taxable income. So for example, you've got partnership, mum and dad, mum's looking after the kids, dad's working on a high position jobs, and we're going to get some extra income from, say, a commercial property. How about we position it so that mum gets the income to absorb some of the lower marginal tax rates? And especially important coming up into 24 when the new tax rates come in. Now just remember, there's always a bit of trade-off between one on the other one. So you've got to really be clear or at least think about what your priority is, asset protection or minimum tax. And then we work on how we go about it. Finally, you got some things like retirement, not finally, but an extra position is how can we be structured so when you do come to retirement, the income is flowing through at a position that will minimize your tax overall at age. Remember, if you don't have any other income and the income's coming in, between two of you, you've got at least $40,000 or thereabouts tax-free from income. So that's a good thing. And then you've got the kids. Now I've got 3 girls. How can I pass on whatever I have to them without actually writing or transferring the title to them? My father at the time, when I started practice, he says, oh, no, you're an accountant now, so how about I just sign over to you? I said, well, wait a minute, Dad. Now, we don't really want to sell this property. It's good rent and good growth. So, you're going to sign it over to me. You're going to be up for capital gains tax. I'm going to be up for stamp duty, and we still got the same property. So is that smart? So is there another way to do it? And that's one of the things we would look at. Then you've got to look at the future. What's your life likely to be? What's your cash flow likely to be? Are you going to be able to service debt? Are you going to be working with some businesses? What the situation is? So these are important items. And finally, you've got to look what the lenders are prepared to work with on what sort of structure, how much it is, where the limits are, what guarantees they're asking for. Then you've got to also, we get situations where there are split families. How do we account for them in a particular structure that was started before? Let's assume it's a trust and you already had beneficiaries. Now, as you remarry and you've got more beneficiaries, they still might be eligible. So who is the controller of the trust and how can we manage one against the other one in case there is a problem down the line? More than that, look at what sort of asset we're going to get. What type of property? Is it going to be residential? Is it going to be commercial or retail? Is it going to be land only? Or are you buying something for development? Each one has different considerations. So really, you need to look at the project. You need to look at your strategy. You need to look at the end first. What are you trying to achieve overall? Now, one final thing that always comes up when the tax office comes for an audit in these situations, they look at intention. Now, intention is not really defined in the Act anywhere, but they will look at whether your intention was always to develop and sell, for example, which makes it carrying on a business. That means the profit that you're making is actually going to be considered business income and added to your tax return, and also you'll be subject to GST on the sale. So that's something to consider, as contrasted to if you develop a project with, let's say, residential housing or townhouses, and you want to keep it for rental. I have one of my clients I was just speaking to a couple of days ago wanting to do that. So if you do that, then it's on the capital side. You don't need to register for GST. But again, you need to tell the ATO through your actions that that's what you're trying to do. So these are very important considerations right through. Adding to that, again, with having the end in mind first, is it going to be a short-term project or a long-term project? That will determine what kind of structure you want to have in the ownership position. Right? For example, if you're going to do a short-term develop and sell, you may have it in a company, right? Or you may have the company have shareholders which are trusts and so forth. If you're going to hold the property for the long term, well, the company is no good for you because you won't get the 50% discount, which I'll describe later on. Then you've got to look at your tax benefit. If you're going to do into a negative gearing position, you want to save some tax during the ownership period. How long is it? Or you want to go towards the end when you sell it, you want to split the capital gains tax because it's owned by 2 people or more. And then finally, if you come to refinance, what about the interest there? Is it tax deductible? And usually the principle behind that is that interest is deductible depending on how you use the loan funds. So there's a lot of things to consider. So Amir, tell us what structures we've got to work with.
So, who can own property? The most common are individuals. So you buy the property in your individual name. Then you've got partnerships. So husband and wife, for example, can buy property. Then you move on to companies. A company can buy a property. And we'll go into each one, the pros and cons of each. A trust is also an entity that can buy property. And finally, super funds. They are the most highly regulated, but there's also some benefits in that to consider.
So given what we've just said, we're going to ask you a bit of a quiz question. We're going to give you about 5 seconds to answer, and you can type it into your chat position.
Whose name do you think should be on title? Trust, individual, company, joint, partnership, or SMSF?
Taylor, are you getting people putting in names?
Yeah, some of them are saying it depends. Depends on the situation. Trust, all of them. Someone else is saying SMSF. Depends.
So,
Trust. Quite a few depends on the setup or situation, and then quite a few trust as well.
All right, so we've obviously got a lot of good lawyers here, because as any good lawyer will tell you, it depends. It depends on your circumstances, the situation, the property. There are lots of different factors you need to consider. So the correct answer is it depends on the circumstances.
So let's have a look at some of the advantages and disadvantages of ownership of property in each of the structures. If you're going to own it in an individual name, well, you've got effective control over it, right? It is simple up and set up. You just sign on the contract and off you go. You get access to 50% discount on capital gain as long as you hold it for at least 12 months. You get the main residence exemption as well, so because that's only available to individuals, you can't really have it anywhere. But on the disadvantages side, you can't really split the income if that's one of the things, one of your objectives. There's limited opportunity for a bit of tax planning. And liability is unlimited, so if you do get in trouble, all the assets are exposed, not only just that property. And of course, one of the, I got stuck there, jointly with the spouse includes assets. If you do get in trouble and you're holding other assets jointly with the partner or the spouse, they're exposed as well based on your problems. With partnerships, what you've got is you're splitting income. So you're already managing the tax position. You share based on your positions between the partnerships. The disadvantages is that income splitting between family members, you got the share of the partnership losses, that can be taken. I'm sorry, I didn't say that in the advantages, yes. But the disadvantages will be the joint and several liability of the partners. So if one partner gets in trouble, he impacts on the other partner pretty much where there's a claim from a third party. Going to companies. The great advantage of companies is the liability for the shareholders is limited. And the structure, it's limited actually to the amount of shares of capital that's available.
And there are lots of rules around that as well. So it's not a blanket. It is limited as long as they don't give personal guarantees, of course.
And of course, a company is very well understood commercial structure, and it is easily used and accepted. And you're able to raise capital if you've got a big project. One of the other advantages is that if the company does make profit and pay out dividends, it can be franked. So you've got dividend imputation as well. So the tax is only taxed once. The tax rate for a company that's trading is only 25%. And the example for a company that's trading with property is that you're actually a developer, okay? Or you want to sell out all the property that's going to be held in that company. Profits, on the other hand, can be retained. You can pay the 25%, right? And then use the profit to do a next project. Now that needs a bit of planning, but that's where you're at. The disadvantages of having property in a company is that if you give personal guarantees as directors, that eliminates the benefit of the limited liability and exposes your personal assets, such as your home, to the problems. And in properties, there is no discount to capital gain. Yes, your tax rate's only 25% or 30% if you're just getting passive income, but there is no discount. So when you come to distribute the money out as dividends, you may make up the rest of it in the individual tax return up to the 47% marginal tax rate. Right? So that's what happens, and that's where you need the planning and be clear about what you want to do. Let's talk about trusts. But let's start with trusts, about what it is. Okay? Generally, I like to tell this story just so that we can all agree on what a trust is. An individual is an entity in their own right under common law. A company is an entity under the corporations law. But what is a trust? The history of trusts comes in the medieval England. And if you've ever seen Russell Crowe in that Robin Hood movie, that is ideal for what that position is. You had King Richard crusading to the Middle East, and who was going to look after England during his absence? He goes over to his brother Prince John and says, I appoint you trustee, making him the legal owner. He says, I entrust in your care the land and estates of England. He gives him some assets. And he says, your job is to look after the assets on behalf of the people who are the beneficiaries. So with those few sentences, he's created a relationship of trust between the legal owner and the beneficial owner. So if we have a look at today's sort of structure, you've got the trustee up the top, who is the legal owner, and these days we'd like the trustee to be a company rather than an individual. Why? Because a company's got limited liability. Also, it allows transfer to the next generation without any tax, capital gains, or stamp duty. Why? Because the title on the deed will not change.
There are a few types of different trusts. The most common one and most referred to is a discretionary trust or a family trust. This is very good for a small family group where all the parties are related. A next one is the unit trust or a fixed unit trust. This works well for an unrelated group of people who are looking to buy a larger asset, for example. Another type of trust you may have heard of is a testamentary trust. This has a lot of benefits for leaving money to minors. It is part of the will, so it's triggered on someone's passing.
Usually grandparents to grandchildren, because the children who get income from that type of trust will be taxed at adult rates rather than penalty child rates.
And then there are two which are not very commonly used now, which is a hybrid trust and a class trust. A unit trust, like I was saying, allows for pooling of funds for a non-related group. So if a group of friends want to buy a larger asset, they can do that through an entity.
For example, commercial properties, in the millions. These days, the rates are better on the larger asset rather than the smaller $1 million jobs. And so you need a lot more people to come up. Nobody has, $6 or $7 or $10 million to buy one project.
And one of the benefits of the unit trust is it clearly identifies each participant's share of income and capital. And it also allows for a streamlined and simplified management through the entity, which is the unit trust, and then the distributions will go to each of the unit holders.
So what that means is that if you've got, say, 10 unit holders and participants in the investment, you nominate, you'll have a corporate trustee, you'll nominate one or two people to be the directors who are going to sign all the papers and so forth. So those directors will liaise with the other 8 people, and once decisions are made, it's easier to manage with the lenders and other regulators.
Another benefit of unit trust is if there's a capital gain, it will flow through if the unit holders are entitled to the 50% capital gains tax discount.
Amir, what about discretionary trusts? They're usually referred to as family trusts.
Yes, they are the most common one, and a lot of different variations of them. So you may have heard of bloodline trust, but a discretionary trust is the most general. It allows for the widest number of beneficiaries. One of the good benefits of it is it's good for asset protection if it's done right. It also helps in tax planning. So it gives you the flexibility to distribute before year end. So you've got to distribute the income before year end to one of the beneficiaries, and you can plan by that to distribute the income to the lowest marginal tax rate beneficiaries. You can also stream the capital gains tax and the franking dividends to the individuals. Again, there is a process for that, but then if the individual is entitled, they can benefit from the capital gains tax discount.
How the assets are protected is that none of the beneficiaries actually knows what their share of the asset is. So if you've got a property in there, none of the beneficiaries knows what their share of the asset is until the trustee, of whom you are the director, makes a distribution. So a third-party creditor cannot come and claim anything on that property inside the trust, because who owns it? Nobody knows. That has its own disadvantage, but for now, that is how the assets are protected. And of course, with a trust, you must distribute the income at the end of the financial year. You can't keep it in like a company. So what happens is it allows you to choose which beneficiary has the lowest marginal tax rate and then declare the distribution down to them.
Another good benefit is it hides the assets from the public eye. So because there is no public register of trusts yet, it's not like companies, it's more hidden. Another very good benefit is succession planning, like we said. So if there's a corporate trustee as the trustee, you can pass on the control of that trustee from one generation to the next without triggering stamp duty and capital gains tax.
Now, one of the things that discretionary trust also allows you is that if your trust has a capital gain and it has franked dividends, it allows you to stream it to particular beneficiaries. So you find the beneficiary who has maybe a capital loss and you stream the capital gain to him or her. And similarly with the franked dividends, if somebody hasn't got any income, then you put the franked dividends going to them and they'll get the franking credits back. So these are some of the advantages that are available for discretionary trust. Amir, what about disadvantages?
Just before we move on to that, there's the family trust election, which is very relevant for some trusts or groups. That helps absorb losses, and if there are large dividends, that's something for you to consider as well. The family trust election. Some of the disadvantages of trusts, you would have read in the news recently, the ATOs focusing on it. There's a lot of talk about it, but the reality is It still has its benefits. Some of the disadvantages are land tax, particularly in New South Wales, where there is no land tax threshold. So for individuals, get a land tax threshold. For trusts, they don't get a land tax threshold.
And Amir, at that point there, what generally happens is that if you are investing in one of those states, say New South Wales or Victoria, a trust is still useful after you've owned 2 or 3 other properties that take you to the individual land tax threshold. And then if you're buying the next property after that, you're going to pay land tax either way. So you may as well have it in a trust and have the flexibility.
Another disadvantage is the setup cost. There is initial cost to set up the entity and the trust. But if you take the long view and average it out, that kind of, you'll get more benefits if the numbers stack up. Another consideration is the complexity while setting up the trust at the beginning. A lot of people are not very familiar. That's why we have these webinars. That's why we help all our clients with the process along. So it becomes a lot more...
As you get familiar with it and you do it each year, you'll find out what's how to manage as you're going along.
Another consideration was dealing with financiers. So a few years ago, there weren't a lot. Currently, a lot of the banks are very familiar with trusts. Some banks prefer to deal with the trust, especially for commercial properties. So that's becoming less frequent, but always speak to your financial advisor and broker before you do that. And one of the last things of a trust to consider is the foreign person surcharge on land. A few years ago, state government started to introduce surcharges for foreign persons. This is specifically for or more targeted towards residential properties. And what it does is it adds a surcharge on the land tax and stamp duty if there is no specific exclusion for the foreign persons. So that's also something to always consider when you're setting up the...
That was in response to foreign income coming in and pushing up land values for properties. Governments felt that it was impacting first homeowners, and so they needed to do something to discourage them on a commercial basis, and that's how they did it.
Another thing is property in super. So that's another place you can own property in. There are lots of advantages for super, and that comes with some higher regulation. One of the advantages is super only pays 15% tax on its income while you're in accumulation phase. And then if you sell an asset while you're in accumulation phase, you only pay 10% capital gains tax as opposed to whatever your marginal rate is in the individual name. It's very good for asset protection against creditors. It's also good for contributions when you're aged 50 or above.
Is your spouse or partner in a marriage breakdown position.
And then there is no asset protection or very limited asset protection. The other thing is there is no tax in pension phase. So once you reach a condition of release and you're in pension phase, there is no tax on the income of the...
On average, that's around the 65 age group.
Some of the disadvantages is you can't get the cash out. So once it goes in, until you reach retirement, you cannot get the cash out.
So that creates a bit of a problem, as Amir is saying. If you want to do another investment and the cash is already sitting in the super fund and you're in your 40s or 45, then makes it difficult to go on to the next project when the money is sitting in the super fund and there's not enough there to take on the project, and there's some limitations.
Concessional contributions are limited to $27,500 per year per person. Liquidity could be an issue if the fund, all it owns is a single asset. And another thing is the detailed administration. Because there are so many tax concessions for super funds, the ATO requires a lot of detailed administration for the super funds.
All right, so really, at the end of the day, in Shakespearean terms, the question is to trust or not. So in order to make that decision, consider this. Firstly, if your risk profile is high, then yes, do consider trust very heavily and do it. If it's no or low, then maybe, because there are other opportunities to use trusts simply than to own the actual property inside the trust. It can be used in other formats. And let me give you an example. For example, we had a client who was from overseas, and they were over at Sydney University, and she was a young person, Dad bought property in a very exclusive area, quite expensive, and they were going to put it in her name. And when I suggested, well, look, if you're going to put it in her name without anything else, then that's a real problem, because should anything happen, she gets involved, then somebody may put a claim to the whole amount. So what we ended up is setting up the trust, having Dad gift the money to the trust, and then lend it to her with a mortgage. So should she get in trouble, then the money, at least the principal, comes back. So these are some of the things. Other things, you've got the cash flow and the gearing. Is it positive or is it negative? So that would help to decide whether you want it in a trust or not. If it's negative, it's going to be locked into the trust and it has to be rolled over into the next year and offset against future income. So what is the future of the income for that trust? So Amir, so the next part is going to be, what you got to do? Well, first, I recommend you get professional advice. And you've got to really plan it with each new property purchase or each new transaction. Look at the situation, because things are fluid, things change, as we've mentioned before.
So, people we help are aspiring investors from 1 or 2 properties. They're looking to start in the property journey, usually positively geared positive cash flow, but negatively geared, and usually on PAYG income. Then you've got the experienced investors between 2 and 5 properties. They're usually on either PAYG income or business income. They've got their structures in place because they're starting to utilize their thresholds, land tax thresholds, and they would have considered companies and SMSFs and have looked at their estate planning. And then you've got the veteran investors with 6+ properties. They would have done most of the things and also looking at subdivision developments and joint ventures.
So the question really is, why do you need professional advice? Well, consider this. How much will it cost you if you get it wrong? There's no black and white, I agree, but what is the best position? Compare that to the value of good advice. So how much will it cost you if you get it wrong? Compare it to the value of good advice. You're spending $1 million, $2 million, $3 million, and how much is the advice worth? So before you take any action, the key is going to be like this. You've got to calculate the economics of and the cash flow of the proposed transaction. Discuss the proposed strategy. How are you going to exit? And plan the ownership structure with that. And finally, get the professional advice to put it together properly to achieve what you want to do. So what do we do, Amir?
So we provide advice around structures and formation. We help clients with their tax compliance and tax returns, GST, capital gains tax calculations, and their SMSF compliance. We help clients analyze cash flow and other analysis before they go into projects. We help research tax positions and special tax reports. And we also can provide statements of advice for SMSF formation and compliance.
So look, that's it from us. We're happy to take questions at the moment. I hope this was of benefit and we're looking forward to helping out.
So yeah, we've got quite a few questions in the chat. So we'll start off with Kerry, who submitted the following question. She said she's a single woman who owns 2 properties and both titles are in her name, has been leasing one and now to move into one shortly. What is the best way for tax minimization for the other property? Or what is the best way for tax minimization and then the other property is to be given to child debt-free? How to transfer title without cost. So there's a few questions there. Which one you want to tackle?
Look, no, the starting point is always we've got to know about the other position of the person. So what we're discussing is how do we approach a problem like that. First of all, the limitation is that the properties are both in the same name, they've already been owned and they're on title. So leaving a property for a beneficiary of an estate in your will, that is one consideration that we would have. But shifting the actual ownership and changing title needs a lot more consideration because you've got capital gains tax, you've got stamp duty going with it. So the question is the property, was it main residence? Is there exemptions? And so there's a number of other questions that need to be, but that's the process we would approach it with.
Okay, next one is there any CGT exemptions for partnerships?
The partners would be assessed on their individual income, so their share of the income. And then depending on what the partner is, if it's a trust or a company or an individual, depending on the partnership, that will flow through to the ultimate partner.
So if you've got, let's say, mum and dad, which are partners in one property, and that was their main residence, and they lived in that, that would be exempt for each of them. But how the tax office looks at things is that each person's equity in the property is separate. So the tax returns are prepared on an individual basis. So they look at 150% portion, the other 50% portion as you're going through.
Okay, next one is can banks access family trusts via a personal guarantee?
So a person depends. That actually depends.
That's a question best left for the brokers. But broadly speaking, when it is said, can the banks access, the question is going to be of security, right? So if the trust gives the property that's in its name as security to the bank, then yes, the bank can come in and take that property back if the loan is not repaid.
And usually, again, depends on the structure. If the property is being bought under the trust and the beneficiary is giving a personal guarantee, then the bank will go to the trust first and then go back to the individual. So again, we need to understand more detail about it, but
yes. But that's the approach. The approach is, yes, there are some room around, but the key for planning is to try and eliminate and minimize that exposure.
Okay, another one, does bank lending get affected with discretionary trusts?
It depends on the properties, it depends on many factors. I've seen it sometimes increase borrowing capacity, sometimes it hasn't, because a bank, if you're buying a new property, bank will assess the borrower, and again, this is best to speak to a broker, but the banks usually assess the individual who's borrowing, and it's just the ownership structures under trust, and they might be a guarantor to that. So
look, some of the brokers we talk to, they usually, after speaking with the client, finding out their position, finding out their capacity to borrow, they may speak with us and say, well, look, is there a better tax position to put together this deal? And that may suit the client. So both the tax position as well as the lending to get affected at the same time.
Okay, then we have a question about succession. So John wants to know how succession works with discretionary trusts when you have a lot of kids, so like 3 to 4. Who manages this trust after it's passing on? And then he also wants to know how trust succession works when your kids have kids, and so on.
There's a lot of talking. You have to hold, you have to understand your kids, and the basic succession position is transfer of control, okay, of the property. So you have a property inside a discretionary trust. Now, as you pass on, you're going to pass the control via the corporate trustee, and that is the number of shares you're going to issue. If you've got 4 kids, you may issue 1 share to each, or you may split it. So they have to agree between themselves when they come for that property to either be sold or dealt with. So there's a lot of talk going in there, a lot of planning first before you come to an end decision on that. But that's how the succession goes, okay? Depending on whether they want to sell that property, move it on, hold on to it. But they have to agree. The kids have to agree after they take control.
Okay, here's another question. I've had a financial planner state that discretionary trusts will be shut down by the ATO as they are there to minimize tax. What do you need to have in place to ensure you're not breaching ATO requirements of a trust?
all right, so like I alluded to before, there is a lot of focus on what trusts can do and can't do. Again, There is a lot of talk in the media about capital gains, negative gearing. Do you believe everything that's being said? Whether it gets implemented or not, I don't know. But what I do know is trusts have a place for a lot of other reasons as well. It's not only it's not only tax planning. Tax planning is one of the key benefits. And whatever the ATO rules are, comply with them at the time.
The ATO overall is trying to eliminate excess. Excess from people taking advantage. Some of the advantage is where, let's say you've got a trust, it's got a lot of income. The income is supposed to be paid out to a beneficiary whose marginal tax rate is low, but has no control over that money, and it still stays within the trust and the parents, for example. So they're trying to eliminate the excess so that they make sure everybody is equal. But when it's planned properly, so the whole key of what we're trying to do here is to say planning, consideration upfront before the action is where it all happens.
Okay, and then here, Sankar wants to know if there's any possibility to transfer existing properties into a trust.
Look, the answer is always yes, there is. It will cost you stamp duty and capital gains tax. The question is, what's the benefit? What's the trade-off? Like we recently had a client who bought a property in their individual name. This realized it might be rezoned shortly thereafter, and it could be developed into several townhouses. So this was within a very short time. The property hadn't moved in value, and it wasn't of a very high value. So we helped the client. We did the numbers for him and realized that the potential benefit of moving it from, again, asset protection and a lot of other things would way outweigh the costs that would be involved, and then we did it. So again, it depends on the numbers. Does it make sense? First of all, ask yourself why you want to do it, and does it make sense? And is there a better way of fixing it? Because we get a lot of cases, clients saying, I want to do this, and maybe there's a better way of achieving the same outcome. And again, we need to understand more, have a chat, and then potentially help.
Amir is great on the numbers. He does these things very well. And the key is going to be this, for this particular example. So if you bought the property, now if you're going to sell it into a structure, for example, a trust or a company, then you're going to be up for the capital gains tax and you're going to be up for the stamp duty. The question is, the profit coming out of the structure may have a lot lower tax than what you've paid here, and you're able to split it a bit better. So that's the consideration that we would take in trying to arrive at a conclusion to say, well, does this particular transaction work if we did it this way?
And is there any other objectives behind it? Is it asset protection? Is it succession planning? Why? Why is the key?
Okay, then we've got a few questions here about, can we buy land in a super fund, vacant land?
All right, that's a very good question about super funds. Super funds, again, are very highly regulated. We cannot give any advice. What I would understand the objective of buying land is one of two things, either for the land to appreciate in value or for them to develop it. Each one has its own set of rules and restrictions.
One of the rules in super funds broadly is that you cannot change the character of the property using debt. So you can't go borrow money in order, for example, as Amir was saying, to develop the land. But if you're just holding it in its own right for 5 years because you think it's going to be rezoned, then that's okay. That is not advice, that is just general information.
Who can become a beneficiary for a family or discretionary trust? Is there a minimum age, for example?
All right, I've got, over the last few days, a client who set up a family trust for herself 10 years ago. She put her kids who are minors, she put her nieces and nephews as beneficiaries who are now older. What that has done is, if she goes to the bank will verify each one. So the answer is, you can put a lot of people, but the simpler you make it, the better. The other thing is, a discretionary trust usually has, and that's the benefit, it has a very wide definition of beneficiaries. So it says the named beneficiaries, then their kids, their grandkids, their husbands, their wives, their parents, their grandparents, their uncles, aunts, nieces, nephews, and so forth. So there is a very broad definition, companies they control, companies they're directors of, depending on your trust deed. So it's very, very important to read the trust deed and understand who the beneficiaries are.
So the limitation that Amir is referring to is where those beneficiaries are what is called the primary and named beneficiaries, as opposed to being in a class. So the trust deed will define a class of beneficiaries being the family, but the family will rely on who is the primary beneficiary. So if it's mum or dad, then it's mum or dad, their parents, their grandparents, their kids, their brothers, their sisters, and so forth. But so if the children fall within that class, it's much easier with the bank than having the children as named along with mum on the front.
Okay, we are nearing the end of the webinar, so I'll do one or two more questions. Can we use an existing discretionary trust that covers an extended family group for protection and tax planning of a smaller family group contained within that?
Oh, that's a very big question. That needs to look at the circumstances and look at what the risks are, who the people involved are, and how do they want to move forward, what are the assets involved there. So there's a number of questions there that need to be clarified first before you can move forward. And there may be different approaches to the outcomes that you're looking for.
Okay, here's a more general one. If your property makes a loss or your investments make a loss and it's owned within a trust, is that loss isolated in that trust? And they specifically referring to a unit trust in this question?
The answer is yes. Any losses in a trust are quarantined. That's the word they use. It's quarantined and carried forward to be offset against future income of that particular trust. So a trust cannot distribute losses, it can only distribute income. So if you have losses, it gets carried forward into the future years and it offsets against future income and then the balances are distributed out.
Okay, I think we have time for one more question. Can I put multiple trusts or properties under a single corporate trustee?
The short answer is you can, but it's not preferred. Just from an identity and separation perspective. So from a legal perspective, I believe you can,
it can be done.
But it's not the best way of doing it.
The administration is not great. Let's say you go to the bank, and of course the bank wants the name of the account to be ABC Proprietary Limited as trustee for. Okay, now ABC is going to be on a number of as trustee for, and I can guarantee you, because we've had it before, there will be problems. Somebody somewhere along the line in year 3, year 4 will make a mistake and stick the money into different accounts or coming out from different accounts, and it's going to be hard for the administration in doing your accounts, your tax returns. So the preference is yes, it can be done, but prefer not to do it.
Okay, I think that's all we have time for today. Is there anything else you'd like to add, the two of you?
Thank you very much for making the time. And
indeed, if we can be of help, well, please send us inquiries through the website or just call up and we'll send you an invitation to an initial consult and we'll go through there. There are a lot of matters around these things, considerations. You've got to look at your personal situation going forward. Thank you.
Thank you.